Good afternoon, everyone. Good evening, everyone. Good morning, everyone. Welcome to session 9 of MOOC 10, Cryptocurrencies and Financial Institutions. Thank you, everyone, as always, for joining. Thank you for sending questions. We have a few questions that I will go through, and then we'll see if we have more questions in the live chat, or if there are other things you'd like me to talk about, or if I'm going to go through anything else that I think is relevant. But I think there are some interesting things to discuss. Okay, I'm going to jump right into the first question. Is it true that 99% of ICOs are frauds or not ready for blockchain development? Would regulation be the answer, or would this affect innovation and create more delays? This is a very good question, very interesting question. And let's start with the first part of the question. I do believe that, let's say last year, at peak ICO craze, the large majority of ICOs were, best case scenario, destined for failure. So let's call it that way. Now, why do I say destined for failure and not frauds? Some of them were outright frauds, where people were raising money from naive and gullible people and never had any intention of doing anything than taking that money, going and having a nice life, and never actually doing what they said they were going to do. That was definitely one bucket. There is a second bucket of slap blockchain on it, but it's not exactly clear why a blockchain is needed in this environment. And so these aren't necessarily people who said, I am thinking about how I can defraud people. They are people who are saying, you know, I really want to make this product to serve this market, and I've concluded, with some basis, that it will be easier, much easier, to raise the money to do this if I say it's an ICO, it's a blockchain, and so I'll kind of reverse engineer my product to put a blockchain in there so that I can raise the money, and then I'll go build it, and why not have a blockchain in there? And these things are also going to fail as a general rule, because, you know, the mode answer to do I need a blockchain is no, right? Like in most, for the answers to most questions in life, in the format, do I need a blockchain? The answer is no. Blockchains serve very specific purposes that serves very specific needs. And here it's not just do I need a blockchain, but do I need a blockchain and a token that is going to have value? And the number of scenarios where that makes sense is even smaller. There are some scenarios where that makes sense. And there are some scenarios where not only it makes sense, it's going to be transformational for a wide variety of fields and industries. But that's very different than coming to the topic from, here's my random idea, let's put a token on it. You know, I want to provide some product or service, and I'm going to deliver it with a token, where the reality is all you're doing is inventing an extremely, extremely inferior form of money that just somehow only works at your store, which is, it's weird, right? Like many ICOs, there's like a whole bucket of ICOs that could basically be described as, this is the high fancy words, buzzwords version of store credit. right? So you're saying, oh, I'm going to make a exchange, and the only way you can purchase things in this exchange, or the only way you can purchase dental services, or the only way you can purchase A, B, C, D, E, or G is with token A, B, C, D, E, F, G, but without having thought through the incentives and game theory that says, like, there's actually value in a token here, and what you're really just buying is you are funding someone, you're pre-funding someone to build a business by buying store credit in advance, and that's unusual. Like, you don't do that in the real world. If I wanted to build a hotel and I needed money to build a hotel, it is unlikely that if I said I need $30 million to build a hotel, would you all like to buy 50 nights at this hotel over the next few years and just prepay me now? And and hopefully when I build the hotel, it will be, you can then exchange your store credits. People don't do that because, you know what? The way markets have evolved, correctly speaking, is that I don't have to pre-finance a hotel building in order to get a night at a hotel room. People are perfectly happy to build hotels on their own dime, and when the hotels are built, are willing to rent me a hotel room for a one-night basis for that one night that I want. And I don't have to lock up my money for the next 5 years in the hope that you build a hotel and in the hope that your hotel prices are going to rise, and therefore my store credit, I bought the hotel room for $150, and now they're $200. So woohoo, my hotel room voucher is now worth $200 instead of $100. Isn't that a great deal? That's not really a great deal for the customer. It's not really a great deal for the investor, and so on. So this is bucket of things that might be perfectly valid businesses. Building a hotel, being stapled on a blockchain, because if they say, well, if my customers are willing to pre-fund the building of my hotel, that's very good for me, the hotel owner, right? If I wanted to build a hotel in normal ways, I would have to go out, get equity investors, get debt investors, and all these investors will have all types of annoying expectations of me. The debt investors, the bank, are going to want regular payments on the loan, and they're going to ask for quarterly reports of if a business is doing meeting the projections, and if it doesn't meet those, some credit officer from the bank will come have a chat with me, and if things go off the rails enough, they might actually take the hotel from me. And then the equity investors are going to have a bunch of other highly annoying requests, primarily taking the equity of the company. So if you could convince the future customers of a hotel to give you all the money to build the hotel, and the only thing they're getting is if the room rates rise, they will have bought their room nights cheaply and they can resell them. Well, this is absolutely fantastic for you, the hotel owner. You've built your hotel and you hold 100% of the equity. You didn't have to borrow any money. And so it's kind of almost impossible for the hotel not to make money for you, the hotel owner. So obviously that's appealing, and some people said, well, let's take advantage of this opportunity, and so on. The third bucket are things that might be perfectly reasonable, either concepts or businesses or ideas towards a business. Okay? Perfectly reasonable. But would never get the type of valuation or financing under normal terms. And I ran into A bunch of these guys. Like there would be, does this make sense on a blockchain? Yeah, well, kind of, sort of. Yeah. Does it make sense to have a token? Yeah, well, maybe. Okay, fine. Fair enough. Who's your team? Well, it's me and this other person and my cat. And what have you guys done so far? Well, nothing. We have a white paper. Have you coded anything? No. Does anything actually work yet? No. Okay. In normal venture capital financing, that would raise probably $0, right? Like at any valuation. You just wouldn't succeed in raising money. And then you ask the next question. So how's it going? So we did an ICO. And so how did your ICO go? I said, okay, not great. And what does that mean? Well, we raised $28 million. And, these guys aren't a scam. They also aren't someone who is trying to staple a blockchain where it doesn't belong. They're just people trying to actually do a business. And the ICO market was so frothy that they were getting crazy amounts of money that the risk reward for the investor was probably not good. That company wasn't mature enough that you would put $28 million into it for just some part of the company, right? Whatever the part of the company was. So you add those three buckets together, and some very large percentage of ICOs, and I don't know if it's 95% or 80% or 98%, but large percentage, were absolutely, positively, for sure, destined for failure. So, first part of the question, yes, I agree. Now, what does this mean? What are the implications? And now this is the difficult part of the question, because it all depends what lens you're looking at this through. I'll tell you what a traditional regulatory view would be, which is, this is why we have investor protection laws. This is why we have securities laws. This is why we don't let random retail investors put their life savings into crazy startup ideas, because they're not really qualified to evaluate them. And they make really dumb decisions, like giving 2 dogs and a cat $28 million for 5% of their company. And of course, that's not going to work. And we really need to take all of this stuff and bring it back into the normal regulatory framework. These are securities offerings, and they should have a prospectus, and they should only be available to accredited investors in certain countries, and so on and so on. And I sympathize with that point of view, right? The ICO craze and the types of things that showed up in the ICO world didn't do very much to improve the reputation of cryptocurrencies and public blockchains, because they more or less played right into the narrative of, yeah, this is all just a big scam, right? So I note that, but I'm going to come back to it. In the late 1990s, when we had the dot-com bubble, all of these securities protections were in place. And still a whole bunch of retail investors through IPOs, threw a whole bunch of money at extraordinarily high valuations at companies that at that point had no chance of succeeding. Whether they succeeded 15 years later in a different format, sure, that might be the case, but at that point in time, people were throwing hundreds of billions of dollars at anything that said internet in it. And of course, you had the famous dot-com crash, and people lost an awful lot of money. And it turns out that even if you have securities laws, and even if you have public markets and all the protections of public markets, when you're in full-blown mania phase, retail investors still find a way to lose an awful lot of money in a mania. So this is the counter argument to this. It says, well, yeah, I mean, possibly would have happened anyway, just have taken longer, right? Like if you went through the whole process, like you do, like people did in the internet years. So yes, it wouldn't happen every 3 weeks. It might take 2 or 3 years like it did in 1999, but people still managed to work themselves up into a frenzy on internet stocks and later biotech stocks and other things. I mean, it does happen, right? And so these two kind of balance each other out in my mind. Now let me be clear. I believe most of these things were securities offerings, and in practice, I have a hard time arguing that if you do something, that if you did it not on a blockchain, it would be a securities offering. But if you put it on a blockchain, it wouldn't be a securities offering, and that somehow makes sense. It doesn't make any sense. Why would that make any sense? Why would it matter what consensus database technology you're using about whether or not a retail investor should have protection on this topic? Can't think of any good reason that would be the case. Now, having said that, there was something very, very interesting about ICOs. Despite the fact that almost everyone that did almost any ICO is going to lose all their money. I mean, that's not good. But there was something very interesting. It showed that there is tremendous pent-up demand for funding opportunities from everywhere around the world, including all types of places, people, entities that are not in the normal startup, venture capital, Silicon Valley ecosystem. And that to me is interesting, right? That there's something there, and if you are very strict about how you would apply all the other stuff, in other words, what's the big problem about applying securities regulation? You should apply it. But what's the real problem? Every country has different securities legislation. So it's not like you have to make a prospectus that's compliant with the US or the UK or Canada or Cyprus. You'd have to make it compliant with 190 countries around the world, and that means it can't happen. And yet this idea that you can aggregate people from around the world to commonly fund a project seems like an interesting idea and an interesting step forward in human development. It's like when that kid at a football game said, held up his Bitcoin sign and said, "Send me money. Send me Bitcoins because I need to pay for college." And he raised, $40,000 or $30,000 and by the end of the football game. And I thought that was super neat. And I'm actually really surprised we haven't seen more of that in charity work. Like, I'm really surprised you haven't seen someone in like some war zone or refugee camp or something. "Oh, send me Bitcoins," right? Like, I would have thought that would happen more, to be honest. So I simultaneously believe all of these things, noting that they're contradictory. Oh, I have one more piece and then I'll put them all together. The fact that it was not clear. Sorry, let me restate that. The fact that it was pretty clear to pretty knowledgeable people that a lot of these things would turn out to be securities offerings made the adverse selection and the scamminess worse. And I will speak here from personal experience. You can imagine during that period, I got a lot of pitches to be involved in ICOs, or for the University of Nicosia to be involved in ICOs, and so on and so on and so on. And because I had no particular interest in A, going to jail, or B, getting the University of Nicosia or myself in trouble with securities regulators, I turned them all down. because it was pretty clear to me that most of these things, people will come back and say, you can't really raise money this way. And this is not because I'm some type of super genius. It's because I've been in the finance world long enough that I kind of know how these things work. And so will everyone else like me. So you have something where you're looking at this innovative new way of raising money, true, where everyone who kind of knows the rules looks at it and says, oh, I don't think I can do this. So that leaves everyone who doesn't know the rules or doesn't care about the rules. And so that is definitely an adverse selection problem. So almost by definition, the people who were doing ICOs during that period either did not have a good appreciation of what rules would then come back and bite them in many cases, or just didn't care. That's not necessarily the profile of, or the system that's going to produce a lot of super high quality investments with super high quality management teams. So my simultaneous views on these are, yes, most of these ICOs were destined to failure and were either opportunistic or naive. 2, almost certainly a lot of these violated all types of securities legislation, and the normal answer is that they should have followed securities legislation. 3, people have done speculative bubbles regardless of securities legislation being in place. So it's not like that's for sure the case that this wouldn't have happened if people did follow the securities legislation. 4, there was an adverse selection problem because of this topic, because people who understood securities legislations were more cautious and didn't participate. 5, people will start applying securities legislations to these topics. 6, if you strictly speaking apply it across all the world to all the countries, you're going to kill the thing that looks interesting here, which is how you raise money from all parts of the world simultaneously. I note that 5 and 6 in particular are directly contradictory, but I do believe both those things. So that's my view on this. There's no completely satisfying answer, but I do think in aggregate those are all the things that went on. So I hope that was clear. Okay, this next question is about payments, sort of. Besides security and or increased privacy of pull payments, e.g. Bitcoin, do you see any other advantages to push style payment systems? Could you elaborate on these benefits or the aforementioned benefits? I don't know if I'm reading the question correctly, but my view is that Bitcoin is a push payment system. It is not a pull payment system. You are not saying, I am giving someone access to my line of credit and they can, well, I'm going to I have to take an active step to push a payment to someone else. Other things that are push payments are, the best one that everyone knows is cash. I buy a lemonade, I give you $5 in cash. I have pushed the cash to you, you have the cash, I have my lemonade. And at $5, it hopefully is one of those very fancy ones with mint and ice cubes and swirly straw. Now, what are the advantages of push payments versus pull payments? Well, they're the opposite of each other. The advantage of a push payment is that it's a money good payment. Once it's done, the other party has it, and you can't pull it back. So that's good for the seller and bad for the buyer. But so then the question is, well, but there's sometimes you as a buyer want to be able to do that. What are those times? Well, when the seller won't sell to you unless they know it's money good. I'll give you a classic example, but then I'll also give you a personal example. A classic example is high-risk product categories, high-risk countries. If you're doing, I don't know, multi-level marketing, vitamin purchases from Nigeria, it is likely that the seller will not accept a credit card, right? They'll say like, yeah, this is probably some type of trick. It's some type of scam. I'm going to sell them the vitamins. They're going to cancel the order. They're going to dispute it. There's going to be an issue. It might be a stolen credit card. I'm just going to block the transaction. And this has in fact happened. I think PayPal has blocked the whole country of Nigeria not because the whole country of Nigeria was engaging in PayPal fraud, but if a certain, still small percentage, but high enough percentage was coming in as fraudulent transactions, that was annoying enough to make their economics unworkable in Nigeria. And so the answer is that you end up blocking the whole country, right? So you can solve that mistrust of the seller by taking the risk upon yourself as the buyer. And while you might not want to take the risk, it might be preferable that the seller takes the risk or the credit card company takes the risk, which is really what happens. If the credit card company will not take the risk and you're therefore unable to transact, then you might want to take the risk just so that you can do the types of transactions you want. This can also happen with time-sensitive transactions. So, real example, we had a colleague at the University of Nicosia that was in Zimbabwe visiting some schools. And she had an accident. She was literally stepped on by an elephant, which turns out to be actually very, very serious because elephants are very large, and so she had a lot of very, very serious injuries and was taken to a hospital in Harare. And the level of injuries that she had was at a point that the doctors were advising us that if we didn't get her out of Harare to South Africa to a more advanced hospital, she would probably die. Okay. And this was happening, at like 10 p.m. on a Tuesday. And I said, well, how do I get someone out of Harare to Johannesburg, wherever? Well, you need to charter a plane. Okay, and how much does that cost? And it was, a lot of money, but like not a lot of money in this context, $20,000 or $15,000. And so the university was certainly not going to let our colleague die in Harare for $20,000, and we certainly have $20,000. In fact, we have a lot more than $20,000. And so I was like, great, please send the plane. And the guy said, well, you have to pay me. I said, sure. Do you take a credit card? He says, of course not, because you might get us to send an air ambulance and fly to Harare and put her in the air ambulance and take her to this, and then, I don't know, dispute the charge, cancel the charge, and now we're out $10,000, and good luck finding a credit card company in Cyprus. And I said, well, what else can we do? He said, well, send me a wire transfer. I said, I'm in Cyprus. You're in South Africa. It's 1 a.m. on Tuesday night. If I go tomorrow morning at the bank at 8 a.m. and go authorize a wire transfer Nicosia to South Africa, probably won't even be there for another 2 or 3 days. By which point, my colleague might be dead, and then I won't even need an air ambulance in the first place. So that's obviously not a solution. He says, well, okay, this is what we do. And so we then proceeded to have a very complicated next 8 hours, 10 hours wasted as we tried to figure out a way to pay the South African Air Ambulance Company with a money good payment that they would be confident that we would not pull it back so they could go rescue our colleague. And it's one of those things where you're like, this is absolutely nuts. Like, we're a large university. We have plenty of money. We have bank accounts. We have credit cards. I am very knowledgeable about payment systems. And I was sitting there running into brick wall after brick wall about how to get a payment to South Africa. And I was doing things like calling other organizations we know in South Africa and saying, look, can you go over to these guys' offices and just give them like $15,000 and we'll pay you back? I obviously asked them from the first moment, do you accept Bitcoin? Because if they accepted Bitcoin, this would have been a non-event, right? So for all the people who said, oh, you don't need Bitcoin for payments, I agree. You don't need Bitcoin to go to Starbucks to buy your coffee. I mean, I really don't think you need that. But if this air company had accepted Bitcoins, this whole thing would have been over in 1 hour, because I would have said, great, what's your address? And here is $20,000. And in a few seconds, they'd have a notification. In 10 minutes, they have a confirmation. And by the time they went and like put gas in the plane, they'd have 4 or 5 or 6 confirmations. They could take off, and they would know that they had the Bitcoins and I couldn't take them back. And I've made a push payment, and it's a money good payment, and it's done. That is the advantage of a push payment. And I would have taken the risk that they would have my Bitcoins and they might not send the plane because I didn't want my colleague to die in Harare. So this might sound like a very extreme example, but it actually happened to me, right? Like, it actually happened to me about a year ago. And ultimately, which is weird, we managed to get American Express Platinum, and this is not a commercial, but one of our board members had a Platinum card, and logically, American Express shouldn't have helped us because it wasn't the person who had the American Express card who had the problem, but they agreed to help, and they negotiated for hours and hours with the airline company, and the airline company was able to accept American Express's assurance that they would pay them. Not that they weren't able to make a money good payment either, but they felt comfortable enough with Amex Platinum that they said, fine, we'll accept your personal assurance that you're going to pay us. And they sent the plane, and we got our colleague to South Africa, and she spent a month there in the hospital. She was in pretty bad shape, but then she came from there to Cyprus and then did rehab, and now she's fine, and everything ended up okay despite this crisis. But it was a very, very painful and dramatic moment for us, which is a crystal clear example that we absolutely do not have globally integrated payment systems, except for Bitcoin and a few things like it. I believe Bitcoin was the only mechanism, or Litecoin or whatever, but for the purposes of this, Bitcoin being the most relevant, was the only way I could have gotten that done in 10 minutes or 60 minutes. It was the only way, which is interesting, right? And I'm looking at the comments, but what happened to the elephant? I don't know. I don't know what happened to the elephant. The elephant was outside of my zone of responsibility. All right. My zone of responsibility was getting our colleague back to Cyprus. So that's what a push payment is. That's why a push payment would be useful. All right, next question. In the case of economic crisis, will surges of fiat flow into cryptocurrencies? Or will cryptocurrencies' values simply follow the fiat market downturns? Do you think large-scale disasters will lead to an evolution of new technologies? Oh, wow, this is the trillion-dollar question, right? No idea. I have no idea. I think this is not a... If I had to guess, if I had to guess, a big part of cryptocurrency's value is going to be not simply as a hedge for global financial disaster, but because it provides some valuable product or service, or one of that product or service might be holding uncensorable money, right? That's where the reserve demand comes from. The reserve demand is there not because there's a fiat financial crisis. The reserve demand is there because it's there every day, right? So I suspect that'll have more of an impact on cryptocurrency values, like if it's actually useful for something, uh, then the whole financial system's collapsing, and I'm sure Bitcoin's going to be okay, right? Because it's hard to be sure that's actually the case, right? Like, who knows? Maybe the whole financial system's collapsing, but you've held your money in Bitcoin, and now you need to sell your Bitcoins in order to like rescue your other financial problem, right? It's not, those things aren't like some type of mathematical formula that you're worried about Citibank, so you're going to put your money in Bitcoin. Might play a role in certain locations, in certain countries, under certain circumstances, but I think more of the demand that will support a cryptocurrency's value at whatever level it gets supported at has to come from it's useful for something. Even if, and I repeat this because I think this is a usage case, even if what it is useful for is, hey, I want to keep 2% of my assets in an uncensorable money. Right? Okay, to what degree are AML KYC regulations for exchanges and merchant services necessary and effective? As cryptocurrencies become more widely used with less conversion to and from fiat, is it likely that, AML KYC regulations will become increasingly ineffective? Well, as you might have noticed in the environment at large, AML and KYC is increasingly popular across all types of countries for all types of reasons, and governments think it's a very exciting thing to be doing. They are trying to crack down on unauthorized economic flows, whether it's sanctions or drug dealing or economic crime or what have you. So increased compliance is not primarily driven by cryptocurrency. It's primarily driven that we're going to a world that has significantly increased compliance burdens for financial institutions. You can see it very clearly in a place like Cyprus, where the last 10 years, the shift in how aggressively the banks chase around AML KYC is, I mean, it's mind-boggling. You need like 17 documents to open a simple bank account, right? So the AML KYC is not going away in general. Now, how have countries applied this to crypto? And the question is right. It implies something, and I'll say what it implies. It implies a correct understanding of how they've applied it to crypto, which is they have regulated the exchanges. And the idea about regulating the exchanges is that is where cryptocurrency interacts with the rest of the system. So it's a perfectly good place to catch it. Right? If I'm just a miner and I send to a crypto wallet, it's hard in practice to AML KYC that. If, on the other hand, I'm sending money to Bitstamp and I'm using it to buy Bitcoins, and then I sell Bitcoins and I send the money back to my bank account, well, it's easy to track it. There's already systems in place to track if I'm sending money to or from my bank account. And so I think the regulators that have said, yeah, no, we're fine with cryptocurrencies, but we are going to apply the full range of AML KYC procedures to exchanges, have made an extremely sensible choice for right now, because you don't want to be chasing around people that are running a miner or just have a personal wallet and ask them to comply with AML KYC, any more than you should ask someone who has a regular wallet and who has cash in the regular wallet and ask them to comply with AML KYC, right? It's silly. So in practice, I think that will capture most of what you needed to capture, because the at the end of the day, and this is a theme I come back to every time I talk about cryptocurrencies, people usually need to spend money in the real world using products and services. And so most of the time you will come into the regular financial system to do that. And so it's a perfectly fine way to say, here's the time to check you. I'm going out of the financial system or I'm coming into the financial system. Will this become less effective if cryptocurrencies become more widely used with less conversion to and from fiat? Yes, but I think we're a long way away from that. I don't think it's highly risky yet, this thing, in terms of happening. I mean, the time when we'll be paid in cryptocurrencies and then use cryptocurrencies to buy houses or cars or whatever, it's a long way away. And even then, there are other mechanisms to catch the big transactions, right? You'll just go and say, hey, if anyone's buying a house with cryptocurrency, please do the AML KYC there. If anyone is buying a Ferrari with a cryptocurrency, do the AML KYC there. Now, could someone be like, I don't know, doing some service online and getting paid in cryptocurrency online and then using that to buy a sandwich? And could they maybe get around payroll taxes that way? Yeah, I mean, probably. But that's not where the big money is, right? Like, that's not, like everything else in life, on these topics, you focus on what the big opportunities are, what the big money is. And most of the time, you're either coming in or out of major transactions in the regular system. And so I think this is a sensible approach. I think this will work for a while, and just for amusement. And I think it might be somewhere. If Andreas could post my post on cash from 4 years ago, I think it still applies, right? Like I wrote something 4 years ago, and I know it's somewhere in the materials, but it's sort of relevant here, that if cash was being invented for the first time today, people would think it's truly nuts, right? Like, it doesn't make any sense at all. It's just because we're used to it, and that seems normal. And because cryptocurrency is sort of like cash, sort of, you get a lot of anxiety about it. But cash is weird in many, many ways. And so, yeah, I see Andres posted it. Now, having said that, the AML KYC guys are not big fans of cash. They're trying to get rid of it. So they're consistent. They're consistent in that regard. And so it's not like their answer would be, well, yeah, we love it that people can use cash. None of them are going to like it. No, they don't like it, the AML KYC guys, because it's not trackable, right? Less because they want to inflate away your wealth, mostly because they want to be able to track where money is going. So I think that's my answer on that one. Okay. Next question. I think it's the last of the questions. Fiat currencies, most trades of fiat currencies, I think is what I'm going to say, are done for speculation through margin trading and not commerce needs. This is an opportunity for crypto, assuming that existing FX platforms offer them for trading. Bias is not pursued by the FX platforms. What if FX speculation platforms are built on the blockchain technology? Wouldn't that eliminate excess margin trading and ensure that people gamble only what they can afford? I'm not really sure I understand this, to be honest. Let me try, because each sentence kind of goes differently. Speculation in financial markets is not a bad thing. It's another word for liquidity. You want markets to be liquid. You want a lot of people to be willing to buy or sell euros or dollars at any point in time, so that if you, for whatever reason, need to buy or sell dollars or euros at any point in time, there will be someone willing to take the other side of that trade without you moving the market price very much. So whether they are speculating, in other words, trying to make money in their trade or not, why do you care? Right? If they're giving you a better bid than the people who are just doing e-commerce, great. I mean, you as a counterparty, you who just want someone to buy your euros or sell and sell you dollars, their motivation is of no interest to you, I think. Right? So I generally not a huge fan of this idea that speculation is bad, but genuine currency conversion is good. I think it's all more or less the same thing. Why don't existing FX platforms offer cryptocurrencies for trading? Well, the usual reasons, right? Like there's not institutional grade yet. People are working towards it, right? But institutional grade systems to allow big companies to trade cryptocurrencies. And this is a variety of things. One, custody. No one wants to be trading hundreds of millions or billions of dollars of bitcoins and like someone loses them. Right? People lose their jobs for that, among other things, and people don't like losing their jobs. Second, I think there's still questions about how this stuff is regulated. Third, there's still some anxiety of like, is this really real? Are we in the traditional financial world, or are we just going after chasing some goofy idea? I mean, that's fading over time, but it's still there. So why the big institutional FX platforms aren't trading Bitcoins? These are the reasons. Now, what if FX platforms are built on blockchain technology and eliminate excess margin trading and ensure people gamble only what they want to afford? It feels like a mission impossible to me. Like, no FX platform wants people to be margin trading to gamble what they can't afford and therefore have economic exposure to that person, right? That's exactly what they don't want. And since a person's ability to meet the margin call is likely not just their wealth in Bitcoins, but their overall wealth, it's not clear to me that a blockchain would solve this problem, right? Because if you say like, oh, let's say I have a net worth of $500,000 and I want to trade, and I have, I don't know, at my brokerage account, $20,000, and I want to trade $40,000. I want to trade $20,000 on margin. The way to not trade on margin is to send another $20,000. But maybe I don't want to do that. Maybe I don't want to sell my stocks. I don't want to pay capital gains on my stocks. If the brokerage firm will give me $20,000 of margin, I'd rather pay a small interest payment to the brokerage firm, do what I need to do with that $20,000 of margin, and not sell my stocks to generate $20,000 in cash to to be able to trade. And saying like, oh, well, on a blockchain, you can see everyone's total assets. Yeah, but A, I doubt it, right? And B, if they're in a form that the platform can say, oh, well, I can grab these, well, then it's just the same as selling your other assets and sending cash to the brokerage account, right? You effectively don't have margin. And I don't think people I don't think people are going to say we never want to use margin or debt again, right? It's all debt has been around for a very, very long time. It has plenty of plausible usage cases. I don't see why it would go away just because cryptocurrency exists. Because again, cryptocurrency is just digital cash, right? Just digital cash. So if I have cash, it does not mean I might not also borrow money. It does not mean I'm only willing to do, I have cash, I only want to buy a house in cash. I have cash, I only want to trade currencies to the degree that I have physical cash on me. I'm not sure that's the case, right? Well, I'm actually sure that's not the case. I'm sure that is not actually the case. So, I'm not sure I buy this, that speculation is bad and that margin trading should be eliminated, or that current platforms want to take on counterparty risk with margin trading, and that a blockchain can make all these things go away. So that's my take on that. So these were the questions. We have 5 minutes. I'm looking through the chat and seeing if there's anything that I can quickly address in 5 minutes. I don't see much. I mean, some questions about, is AML just for the little guys, and aren't there lots of questionable things that happen with the big financial institutions? Yeah, I mean, look, it's definitely the case, right? It's definitely the case that when a big financial institution has an anti-money laundering problem, it is more likely that they will pay a fine than anyone will go to jail, right? Like that, I think that part is true. Whereas when some of the early stage cryptocurrency exchanges didn't follow the AML rules, and to be fair to them, I'm not sure it was totally obvious on day one that they had to follow those rules, because here they are on day one trading like internet funny money. And then later people are like, oh, you're a money transmitter. Now, it's not quite that clean a story, because some of the people that did go to jail knew that some of the things they were doing were questionable. So in those cases, they went after specific individuals, where it seemed a little bit overambitious to me. I think they could have made their point with some pretty heavy fines and saying like, look, this is how we expect this field to work, and now everyone's on notice, and so nobody do this again. And particularly so because there's some big banks that have been caught over and over with money laundering for their clients, and generally pay fines, and somehow nobody's responsible. And the fines aren't small. I mean, they're sometimes very big fines. But for the executives, it's obviously much better that the company, of which they own only a very small part of or none of, pays a fine, than if they personally have to face criminal liability, because that's obviously terrifying and nobody wants to go to jail. So part of, I think, what happens is you're a big bank and you have a bunch of lawyers, and you have some political power, and all of those folks start working to protect the executives. And you make the case that it's a systems breakdown. It's not as if Joe Smith at this office went and said, oh, exciting. I would personally like to go take $100 million of drug cartel money and run it through my account and clean it up. Now, sometimes there are actually war situations like that, but like a lot of it is loose enforcement of internal regulations. And so you kind of come with a shrug and say, oh, you're right, we need to do better and we need to improve and we need to yes, we'll pay a very big fine because we've been very, very badly behaved. And yes, you're going to now put 10 people from the regulator inside our bank to watch us. And all of this stuff can be, reasonably painful and annoying for the company. But usually, not always, but usually the executives have been fairly adept at avoiding their own personal criminal responsibility. And these smaller firms in the crypto space were less adept. And I think that has to do with just the size of the firm. It's not like you can say, oh, well, there's 5 levels of employees between me and the person who did this, right? Like the person who did this might actually have been the CEO or the owner or one of the founders. And there might have been an email saying oh, well, okay, route it this way so it doesn't look like it's coming from you. And when you have that, it's hard as an executive to then say, well, I didn't know about it. Well, here's your email saying you did in fact know about it. So part of that, I think, is a function of size. Part of that's a function of political power. Part of it is a function of regulators wanting to send a message at the beginning. So I think in aggregate, it is fair to say that bigger companies have a better capability to avoid criminal responsibility for AML breakdowns and try and push it towards the civil side to pay a big fine and kind of keep moving. So what are the implications of that? That life is not totally fair? True. But I mean, also just true. Right? Bigger, more powerful entities tend not to work on the exact same playing field as smaller, less powerful entities on all types of things, of which anti-money laundering is only one of them, of which there are dozens. So I don't think it's not surprising that if you're a big entity, you can manage to use your political power to further your objectives. So, okay, I think we've come to the end of our time. It is 7:01 p.m. here in Cyprus. I want to thank you all, as always, for joining. Thank you for the questions, and have a great weekend, everyone.